Welcome to Study Session 5, Responsibilities and Engagement of Auditors. Introduction. In this lecture, we will examine issues related to audit engagement and responsibilities of auditors, management and directors of the companies. Objective. At the end of this lecture, you should be able to describe the issues related to audit engagement and responsibilities of both auditors and companies. Audit engagement. When an accountant in public practice is called upon by a client to act as auditor for that client, the accountant cannot and should not rush to start the job. Rather, he is expected to give consideration to some basic things such as validity of appointment, integrity, objectivity, and independence, professional etiquette on changes of appointment and contract of appointment, validity of appointment. The auditor must ensure that his appointment is valid, that is, he should ensure that he has been properly and legally appointed by the shareholders or any other constituted body or person authorized to do so. To do this, auditor can obtain a copy of the minutes of the general meeting or directors meeting where appropriate, where the decision to appoint him as auditor was taken. Integrity, objectivity, and independence. Before an accountant in practice accepts any audit assignment, he should ensure that he complies with professional standards requirements of integrity, objectivity, and independence. Integrity implies not merely honesty, but fair dealing with truthfulness. Objectivity, which can also be described as independence of mind, is a state of mind which has regard to all considerations relevant to the task at hand, but no other. Threat to objectivity and independence on the part of the auditor in relation to the assignment should be identified and critically considered in the light of the prevailing environment. In addition, the auditor should make inquiries about the potential client and be satisfied that the client is auditable and that the engagement risks appear acceptable. Professional etiquette on changes of appointment. The professional accountancy body to which the auditor being appointed newly belongs has set some ethical rules under its rule of professional conduct for members, which requires a proposed auditor to communicate with the existing auditor of the client as to any consideration which might affect the new auditor's decision whether or not to accept appointment. Professional etiquette on changes of appointment. The following is a summary of procedure for changes in a professional appointment as contained in the Rules of Professional Conduct for Members issued by the Institute of Chartered Accountants of Nigeria, ICAN. 1. The purpose of communication between the new auditor and the existing auditor is to enable the new auditor determine whether it will be proper for him to accept the assignment. This is necessary so as to ensure that the new auditor is not used as a vehicle by which the company could continue any unsatisfactory practices or any impropriety in the conduct of its affairs, or hide such acts from its shareholders or even other stakeholders. When an accountant in practice is asked to act or is nominated as the auditor by a prospective client, that accountant should tell the client that he has a professional duty to communicate with the existing auditor. The accountant should ask the auditor to inform the existing auditor of the change and also to authorize the existing auditor to discuss the client's affairs with him. The new auditor should then write to the existing auditor seeking information which could influence his decision as to whether or not to accept the appointment. If the client fails or refuses to authorize the existing auditor to discuss its affairs with the new auditor, then the existing auditor should report the fact to the new auditor, while the new auditor should reject the nomination or appointment. Where the authority to communicate is granted by the client, the existing auditor should answer the new auditor without delay. Where there are no matters of which the new auditor should be aware, the existing auditor states such fact. However, where there are such matters, the existing auditor should inform the new auditor accordingly. Where the existing auditor fails to respond to the inquiry within a reasonable time, the new auditor should try and contact the existing auditor by other means, such as by telephone or by fax. If this also fails, the new auditor should then send a final letter by a recorded delivery service to the existing auditor stating that if he does not receive reply within a specified time, he will assume that there are no matters which the existing auditor is aware should be brought to his notice. Contract of appointment. After the auditor has obtained clearance through communication with the existing auditor, he can then decide whether to accept the appointment. Other factors such as technical competence of the auditor himself, as well as the level of engagement risk, will also be seriously considered. After the auditor has convinced himself about accepting the assignment, such acceptance will be formalized through a contract of appointment, generally referred to as an engagement letter. When to send an engagement letter. 1. To all new clients before the commencement of any professional work. 2. To existing clients who have not been given such letter in the past. 3. If there is a change in the circumstances of the audit arrangement, for example, change in auditing guideline, major change in ownership or management. 4. In the case of group audit, an engagement letter should be sent to each member company of the group that is to be audited by the firm. Procedure. Either before or upon the acceptance of a new client, discuss the exact terms with the management or the board. Draft and sign the letter before commencing any part of the audit assignment. Receive the client's written acceptance. Every year, review the letter and consider if revision is necessary. Purpose of engagement letter. 1. To minimize misunderstanding between auditor firm and audit client. 2. To define clearly the extent of the auditor's professional and statutory responsibilities. 3. To confirm in writing verbal agreement reached with the client. 4. To inform and educate the client on services to be provided and their inherent benefits. 5. To confirm acceptance by the auditor of his engagement. 6. To clearly indicate the basis of charging the audit fees. 7. To spell out all implicit contracts arising from articles or memorandum of association. The auditor may also wish to include the following in the letter. 1. Arrangements regarding the planning of the audit. 2. Expectation of receiving from management written confirmation concerning representations made in connection with the audit. 3. Request for the client to confirm the terms of the engagement by acknowledging receipt of the engagement letter. 4. Description of any other letters or reports the auditor expects to issue to the client. 5. Basis on which fees are computed and any billing engagements. When relevant, the following points could also be made. Arrangements concerning the involvement of other auditors and experts in some aspects of the audit. Arrangements concerning the involvement of internal auditors and other client staff. Arrangements to be made with the predecessor auditor, if any, in the case of an initial audit. Any restriction of the auditor's liability when such possibility exists. A reference to any further agreements between the auditor and the clients. Companies to keep accounting records. One of the points to be stated in the engagement letter is the different responsibilities of management and that of auditors. Responsibilities of companies in relation to keeping proper records are as follows. 1. Every company shall cause accounting records to be kept in accordance with section 331. 2. The accounting records shall be sufficient to show and explain in the transactions of the company and shall be such as to disclose with reasonable accuracy at any time the financial position of the company and enable the directors to ensure that any financial statements prepared under this part comply with the requirements of the Act as to the form and content of the company's financial statements. 3. The accounting records shall in particular contain entries from day to day of all sums of money received and expended by the company, and the matters in respect of which the receipt and expenditure take place, and a record of the assets and liabilities of the company. 4. If the business of the company involves dealing in goods, the accounting records shall contain statements of stock held by the company at the end of each year, all statements of stock taken from which any such statements of stock as is mentioned in paragraph A of this subsection has been or is being prepared, and except in the case of goods sold by way of ordinary retail trade, statements of all goods sold and purchased, showing the goods and the buyers and sellers in sufficient detail to enable all these to be identified. 5. The accounting records of a company shall be kept at its registered office or such other place in Nigeria as the directors think fit, and shall at all times be opened to inspection by the officers of the company. 6. If a company fails to comply with any provision of this Act, every officer of the company who is in default shall be guilty of an offense unless he shows that he acted honestly and that in the circumstances in which the business of the company was carried out, the default was excusable. 7. An officer of a company shall be guilty of an offense if he fails to take all reasonable steps for securing compliance with the company with section 332 of this Act, or has intentionally caused any default by the company under it. The financial statements of a private company need not include the matters stated in paragraph 1, 7, 8, and 9 of subsection 2 of this section. The directors shall at their first meeting after the incorporation of the company determine to what date in each year financial statements shall be made up, and they shall give notice of the date to the Commission within 14 days of the determination. In the case of a holding company, the directors shall ensure that, except where in their opinion there are good reasons against, the year of each of its subsidiaries shall coincide with the year of the company. Statutory books. The Company Act requires a company to keep the following books: proper accounting records, a register of directors and secretary, a register of charges, minutes books of meetings of the company, meetings of its directors and meetings of its managers section, an indexed register of members, an indexed register of each director's interest in shares and debentures of the company and those of his spouse, infant children, and some other persons, trusts and companies connected with his. Public companies must keep a register of substantial shareholders who have an interest of at least 10% of the unrestricted voting rights at any general meeting. The idea of audit committee was initiated in New York to be established by a public limited liability company. This idea spread to other parts of the world. The issue of audit committee in Nigeria should be considered as contained under provision of CAMA 1990, composition or appointment. The composition of audit committee shall be equal number of directors and shareholders subject to maximum of 6 members. Membership of the committee shall be by nomination from a shareholder, of which such nomination must be submitted to the company secretary at least 21 days before the date of annual general meeting AGM. Powers, functions and duties of audit committee. 1. To scrutinize properly and on a continuous basis the work of the management as well as the internal audit department. 2. To make recommendation on the appointment, remuneration as well as removal of external auditors. 3. To ascertain whether the accounting and reporting policies used in the preparation of financial statements are in compliance with statutory and professional requirements. 4. To review auditors' findings on management matters in conjunction with the external auditors. 5. To put under constant review the effectiveness of the company's accounting and internal control system. 6. To review transactions carried out by company director as well as artificial transactions, that is, transaction between connected persons, for example, holding company and subsidiary, debtors and creditors, husband and wife, and so on. 7. To authorize the internal audit department to investigate matters that are of concern to the committee. Advantages of audit committee. The committee provides assistance to directors in carrying out their legal responsibilities, notably in the areas of accounting and reporting system. The objectivity and credibility of the financial statements would be strengthened. The committee promotes the auditor's independence by acting as intermediary between the management and the auditor. With the audit committee, the communication between the external auditor, management, and internal auditor of an enterprise would be improved. The role of non-executive directors will be strengthened because their effectiveness in making decisions on matters affecting the enterprise would be improved. Responsibilities of auditors. In achieving the objective of expressing the auditor's opinion, the auditor is required first to have obtained reasonable assurance in relation to whether the financial report, taken as a whole, is free from material misstatement, either due to fraud or error. Reasonable assurance. Reasonable assurance relates to the accumulation of the audit evidence necessary for the auditor to conclude that there are no material misstatements in the financial report taken as a whole. Reasonable assurance relates to the whole audit process. An auditor cannot obtain absolute assurance because there are inherent limitations in any audit that affects the auditor's ability to detect material misstatements. These limitations result from factors such as the use of tests, the inherent limitations of internal control, and the fact that most audit evidence is persuasive rather than conclusive. Professional judgment. Professional judgment permeates the auditor's work. It emanates from characteristics such as the auditor's expertise, experience, knowledge, and training. Professional judgment involves the auditor considering a number of factors which may influence decision making regarding the planning, performance, and reporting aspects of the audit. Such factors may include audit objectives, the nature of the subject matter subject to audit, expectations, practicality, sufficiency and appropriateness of audit evidence, reliability of information, and alternative audit tools and techniques. When exercising professional judgment, it is important for the auditor to maintain independence, objectivity, and an attitude of professional skepticism. Professional skepticism. In adopting an attitude of professional skepticism, the auditor makes critical assessments with a questioning mind of the validity of audit evidence obtained and is alert to evidence that contradicts or brings into question the reliability of documents, responses to inquiries, and other information obtained from management and those charged with governance. This attitude is necessary throughout the audit process for the auditor to reduce the risk of overlooking unusual circumstances, of overgeneralizing when drawing conclusions, and of using faulty assumptions in determining the nature, timing, and extent of the audit procedures and evaluating the results obtained from the procedures. An audit is not a guarantee. Professional judgment and skepticism are required particularly when gathering audit evidence, for example, in deciding the nature, timing, and extent of audit procedures, and drawing conclusions based on the audit evidence gathered, for example, assessing the reasonableness of the estimates made by management and those charged with governance in preparing the financial report. Hence, the limitations of the audit process itself and the exercise of professional judgment and skepticism mean that an audit is not a guarantee that the financial report is free from material misstatement because absolute assurance is not attainable. Further, an audit opinion does not assure the future viability of the entity nor the efficiency or effectiveness with which management and those charged with governance have conducted its affairs. that reported assets, obligations, and equity exist and are valued appropriately, and that the required disclosures have been made. Risks of material misstatement at the overall financial report level. The risk refers to the risk of material misstatement that relates pervasively to the financial report as a whole and potentially affects many assertions. Risk of this nature often relates to the entity's control environment. This overall risk represents circumstances that increase the risk that there could be material misstatements in any number of different assertions and may be especially relevant to the risk of material misstatement arising from fraud. Risk of material misstatement at the assertion level. Inherent risk is the susceptibility of an assertion to a misstatement that could be material, either individually or when aggregated with other misstatements, assuming that there are no related controls. Control risk is the risk that a misstatement that could occur in an assertion and that could be material either individually or when aggregated with other misstatements will not be prevented or be detected and corrected on a timely basis by the entity's internal control. Inherent risk and control risk are the entity's risks. They exist independently of the audit of the financial report. Consideration of the risk of material misstatement at the classes of transactions, account balances, and disclosure levels assists the auditor directly in determining the nature, timing, and extent of further audit procedures at the assertion level. Summary. Before an auditor would accept an audit assignment, he should give adequate consideration to issues relating to validity of his appointment, integrity, objectivity, and independence, professional etiquette on changes of appointment, and engagement letter. It is the responsibility of the company to keep proper accounting records, and it is the responsibility of directors to ensure preparation of annual accounts. It is the auditor's responsibility to ensure that he expresses his opinion based on reasonable assurance, professional judgment, and professional skepticism. This is the end of study session 5. Thank you.